I stay at one of the most prime properties in Bangalore, and as you can see around me, this place is quite nice. However, the rental rates at this location has been skyrocketing, and to the tune of 25% CAGR, the growth seems to be phenomenal. This has put my conventional wisdom that renting is always better than buying in doubt. So I thought statistics can help with this dilemma. I put together a decision model based on some data that I found on the internet and simulated a bunch of rental rates and yields in 3 different cities. I then created a proxy investment and expense portfolio of prospective buyers and finally made a utility function for renting versus buying. This utility function was later trained on a log regression model to create a decision model which either supports or doesn't support the buying decision. Now, the way the output came out was in terms of probability, and higher the probability, that signified better was the decision to buy. So the parameters that I used in the model were salary net of taxes, rental rates, investment opportunities, current house value that were available on the market, and this was based on internet data, house loan terms, which could be 10 years, 20 years, and 30 years, and then ready to move in or not, investment returns other than real estate, age group of the prospective buyers, job market, assuming that the prospective buyer is salaried, and total saved up capital that the buyer may have. Remember, a little bit of this will also go towards down payment. Basis this, I further created 2 parameters, which were house loan EMI and savings rate. This was then pushed into a Python script that you can see here based on the log regression model. As you can see in this Python script, I first simulated the data, then created my utility function here, and then subsequently trained my model. While training the model, I got a bunch of parameters or coefficients, and let's take a deeper look at these coefficients. Now, the coefficients essentially were relatively tiny compared to a standard logarithmic model, but that is expected given this is a complex decision model. I fed the coefficients into a prospective buyer's portfolio. Let's call this prospective buyer Anand. Anand makes a monthly salary of 75,000, which is net of taxes. He has a rental yield of 35,000, has investments of about 10,000 rupees, and is looking to buy an 80 lakh rupee property. The decision model predicts that the buy probability, given the current status of Anand, is about 40%, that you can see here right at the end marked in red. And basis that, it seems that Anand may not make a very prudent financial decision by buying this property, even if the rental yield is at 5.3%. Now, this makes sense given that Anand's saved up capital is only about 30 lakh rupees. Now, he would rather enjoy the benefits of compounding on this capital than invest it in real estate where compounding may not happen. His age, however, is right for investing. At 35 years, that's more or less when you settle down and stabilize in your career. This model would depend from individual to individual given the different parameters that the model consumes. So you can use the model in the comment section and see what is your buy probability. And remember, if you're a little risk averse, you should go for higher probabilities up to the tune of 60 or 70%. And if you're not so risk averse, then a threshold of 50 would mean that it's a good investment to bet on. If you need further help in understanding the model, you can go through the description where I've given the details. For more interesting content, you can like and subscribe my channel.